folks. Um, this is Jerry Wink with CSU Global, and I'm doing a video for Accounting 300, and we're going to look at Module 3. Okay, so the first thing I want to show you is the interactive lectures, because I think maybe from the questions I've gotten today that everybody is not reading all the way through. So what I want you to do is I want you to, come on, work with me here. I want you to go all the way through the reading, and when it has, check your understanding. What happens when they are made at the end of the accounting period? Then they're updated to proper balances. Okay, even if you get the answer to the multiple choice correct, well, where did it go? I guess I have to go back. I want you to always click the Learn More button, because there are more things underneath every single one of them, okay? And what you're going to see are examples in here, and those examples are going to be on your CT assignments. So it's going to be important that you check that. So let's just answer one wrong, and then we'll still click more, okay? And see, now it's 1.2. So that's the main thing I want you to do. The next thing I want you to do is I flipped through most of that first interactive lecture, and I came to a button that said download and you can work through a worksheet. Well, they already had it worked out, and I called and got permission to use it for this video, because this is kind of how I want you to do it. Okay, so in that first CT assignment, you are given an unadjusted trial balance right here. So you have an example of it in your integrated lecture, interactive lecture, that's what it's called. Okay, when you get to the worksheet, look at the bottom, because there are tabs. So here's your just a basic worksheet. I wouldn't necessarily call it retained earnings worksheet. Here is a worksheet that takes the adjusted balances and carries them over to the ones that go on the income statement and the ones that go on the balance sheet. Okay, and this is just the balance sheet one. So I want to point out to you that there is nothing for retained earnings on this worksheet whatsoever. All right, if we go back to the beginning and I look all the way across the worksheet, there's no retained earnings in here. So it should just be called balance sheet and not and statement of retained earnings, because it has no retained earnings on it, period. Okay? And I'll show you more about that in just a minute. Okay, then it tells you to do financial statements. So lo and behold, here are samples of an income statement. You always prepare it first. And these numbers are going to come from your income statement columns of your worksheet. Then your retained earnings statement is the next one. So the retained earnings at the beginning of the time period, I think in your CT assignment it's also 0 at the beginning. You add your net income that matches the income statement. You subtract your dividends that are showing up in the balance sheet column right now. And then here is your ending retained earnings balance. Okay, so hold on to that for just a second. And here's your balance sheet. And retained earnings, I'll be darned, it's the 45,617 that we had above. Because the retained earnings, you know what I usually like to do, and I tell students to do it when they're learning. You see how we dated the retained earnings up here? The beginning balance was August 1 and the ending balance was August 31st. Well, this is the ending balance because you're doing the balance sheet as of August 31st. What about that? So the date of your retained earnings has to match the date on the balance sheet. That's a real important concept. Okay, let's go back to the worksheet again. Okay, notice how, well, let me see if I can freeze my panes. That's the view menu, and freeze panes. There we go. Well, no, I didn't freeze them right. Let's try this one. Unfreeze and refreeze. There we go. That's what I want. Okay, so you see my income statement columns here. The credits are my revenues, and the debits are my expenses. And you always really want revenues to be substantially more than expenses, so that's a good thing. And the difference in the 83,100 and the 34,483 is your 48,617. So add the two together and you get back to the 83,100. Okay, if you do that on the income side, you got to do it over here on the retained earning on the balance sheet side. So I don't know if it's going to let me do it or not. Actually, I think it shows it here. It does. So this is your net income, and that's going to get you to the right place because the dividends are already in the balance sheet. Okay, so when you put them over on the retained earnings statement, they're not going to show up on the balance sheet anymore. So let's look for that. At the financial statements, do you see a dividend account? Not in assets, not in liabilities, and not in your equity either. So the dividends are tucked in to the retained earnings number because you subtracted them right there. Okay? So pay attention to that. So look at how these adjusting entries are labeled. And let's talk about those for a second. So, oh, she didn't put them down here. Okay. Well, I can do it. So I'm going to find an A, and that's prepaid insurance, and we're decreasing the prepaid insurance. So that means we've used it up, and we're probably going to put it down here in an insurance expense, and looky there. It's the same amount for A, $208. Okay? B is accumulated depreciation on the trucks. In one of the sections before you download the spreadsheet, in the interactive lecture, it tells you how to compute the depreciation on the vehicles. And what they're doing is they're just doing a straight line depreciation, which is cost minus salvage value, and then you divide that number by the life of the asset. If you want the depreciation for just a month, then you take the yearly rate that you computed and divide it by 12. If you want it for half a year, you divide it by 2, okay? Or multiply it by 0.5. Either way, it gets the same thing. So if you have accumulated depreciation there, then you're going to have some depreciation expense. Up there it is, $275, labeled with entry B, okay? For C, all right, so what happens? Unearned service fees. This is a liability account. Under accrual basis accounting, you cannot record revenue until it's earned. So here, a customer has paid you in advance for their work. So you're going to debit cash, and you're going to credit the amount of money they gave you. So $10,000. Well, that's cool. So now, at the end of August, you have now earned $2,500 of it. So because you've earned it, you're going to debit the unearned service fee so that you only show $7,500 that you haven't earned yet. Okay? So $2,500 has been earned, and you want to put it as a revenue. And it's service revenue in this case. Okay? Sound good? All right. D is, we've got a credit to salaries payable. I bet there's a debit to salaries expense for the same amount. There is. Okay, so here's what happens. You have to record the expenses when you incur them. So for this month of August, what it looks like is the end of the month comes, say, midweek or so, and some of the wages have been earned as of August 31st, so you have to record them as an expense in August. You're not going to pay them until September or sometime, so you put it in a payable account until you get it paid. I hope that makes sense. Okay, E. Oh, it looks like we earned some interest revenue on something. Maybe our cash account at the bank. Whew, wouldn't that be nice to earn $600 of interest in a month's time? That would be pretty darn cool. So we have interest revenue, and I bet up here we've got an interest receivable. We sure do. Okay? So this is when we've earned the revenue, but we haven't collected the money yet. Okay, in my lecture notes for Chapter 3, I have a chart. I think I have a chart in there that has the definitions. There's a 3-part definition for every single adjusting entry, and it works really well. It's also on my videos for the adjusting entries. So if you haven't looked at it yet, I suggest you look at it before you work your CT assignment, and hopefully it'll help you out a good bit. Okay. To go from the unadjusted trial balance to the adjusted trial balance, we do the adjusting entries. Wherever we have an adjusting entry, we combine that amount with a previous amount. Well, interest receivable doesn't have a previous amount, so it's going to go to the adjusted trial balance and all the way over to the balance sheet. Okay? Sorry. The prepaid insurance was a debit of $2,500, and we credited $208, so the difference in that is, I hope, $22.92, and that's what's left in prepaid insurance at the end of the month, and it's carried over to the balance sheet. Do you understand kind of what's going on here? Debits, you add a debit, subtract a credit. If it's a credit, you subtract the debit and add the credit. Well, I picked a bad example, didn't I? How about this one? You subtract the debit, and that's your answer. If you had a credit, you would add it. Okay? So do you think you can, by now, identify which ones are balance sheet accounts? Okay, all the way across. Everything below it is typically income statement accounts. Okay? So you kind of can, and you can look at the account numbers too. All right? Typically when you're learning accounting, the 100s are assets. Even if it's a contra asset, which means it has a credit balance in a category that normally has a debit balance. That's all contra means. It's opposite the balance that should be there, or that's normally there. Okay, your payables, your liabilities typically are 200s. Your equity accounts are typically 300s. 400s are revenues, and 500s are expenses. That's easy enough, isn't it? It certainly helps separate how you're going to do them. Okay, so they continued on, and they put in the net income here so that the assets and liabilities will balance on the balance sheet. And they just showed you that one more time. We looked at the financial statements, and you have an actual statement for retained earnings. So I think the template has this. If the template doesn't have it, you can create these in Excel. You simply click the extra sheet, double click it, and you can type it new sheet, okay? Whatever you want to call it. And then if you want to move it, you can right click on it, and you can move it, and you want to move that to before Oh, let's move it to before financial statements. There you go. It's moved. If you want to delete it, you simply hit delete and you're done. Okay? Easy enough. All right. Both sets of CT assignments have closing entries in them. So what you're going to do is you're going to take the income statement columns, okay, and what you're going to do is you're going to make the journal entry to take all of the revenue and expense accounts and put them over in your retained earnings. So what we're going to do is we're going to make the journal entry that takes that net income and put it into the retained earnings account so it shows up. And we're going to make the entry to take the dividend account and put it in the retained earnings account. Okay? So that's the whole purpose of closing entries, is to close. No, it was an accident, honey. Sorry. Sorry about that, guys. The purpose of closing entries is to close the net income and expenses into your retained earnings, and to make the journal entry to close the dividends into the retained earnings, because you got to make journal entries to get it in there. And that's how, because you pick up the T account that shows the balance of retained earnings, and you got to get the net income and dividends in there so that it'll show up. Okay? So the first, let's see, it says step 1. The first typical entry you make is to close out the revenues. So when we close them out, we want the end result to be a 0 in the T account. So if revenue, which has a normal debit balance, let's try that one more time. Revenue has a normal credit balance. So to make it have a 0 balance, we have to debit the revenue, which is what we did. Okay? And when you have a big company like Exxon or Walmart or some huge Target, Dillard's, whatever, a big huge store, a big huge company, you don't want to mess up your retained earnings account, and it might show up over here. Let's see. Maybe go down. There it is. Okay, you don't want to mess up your retained earnings account with a whole bunch of different entries. You might have 1,000 different revenue accounts to close, or 20,000 different expense accounts to close, and you don't want all that stuck in the retained earnings. So what you're going to do is you're going to create a temporary account, income summary, and you're going to put the closing entries in there. So on that one, we are crediting the income summary because we want it to show our revenues. So if you were to draw a T account for income summary, you could, let me see if I can copy and paste this. There we go. You could type revenues there, and you could type, that's not revenue reference, it's REV. You could type EXP there, and you could take, and then the balance will go over to retained earnings here in a minute. I hope that made sense. We'll see. Okay. After you've closed out the revenues, then you're going to close out all your expenses. So your expenses typically have a debit balance. Okay. To get a 0 balance in them, I put the 0 over here, but that's okay. It doesn't matter. To get a 0 balance, then you have to credit your expense account to get rid of them. So notice all of the expenses are credited. And the sum, and you have to do every individual account, because if you don't, you've only closed out one account. Okay? Or you've closed out an account you don't have. So the sum of all the expenses will be your debit to income summary over here for the expenses. Okay? And then the difference between here and here is your net income. I'll be darned. So income summary has this account, and it's got to be closed over to the retained earnings. All right? So in order to get rid of this account, you're going to credit income summary, and let's try again. No, you're not. What you're going to do is you're going to credit the retained earnings because it's income, and you're going to debit the income summary account, which is what they did right there. Okay? So you have to get the balance first. And the balance, they didn't show you the balance. That's what the problem is here. They didn't show you that the balance was a credit balance. So I'm going to type it in, balance 48617. Okay? So you can see that. And so to get rid of that credit balance, you're going to debit the income summary, and you want to credit retained earnings because retained earnings has a normal credit balance, and you want to increase it with the net income. So you've got to credit retained earnings for net income. Okay, let's move on to dividends. So the dividends had a normal debit balance wherever, there they are right there. Normal debit balance. So to make it have a zero balance, you're going to credit the dividend. That's what they did. And you're going to take it and close it into retained earnings. And you had to subtract it from retained earnings, remember, in the financial statement. So you want to debit, where am I? Right there. You want to debit the retained earnings account. And now you have the difference, which is the balance in your retained earnings account of $45,617. So let's go look. $45,617. I hope that made sense to you. So that's our closing entries. Now, you can add another column to that worksheet for closing entries. And then when you do your post-closing trial balance, all you have are your permanent accounts, which, if you notice, are your assets, your liabilities, and your equity. Okay? All right. On that first CT assignment, I noticed that, I wonder if I have something up for that. I don't. Okay, I noticed that one of them was Virginia Travel, and then they used Virginia Travel Capital Stock and Virginia Travel Equity, Owner's Equity or something. I don't want you to do that. I want you to only use capital stock and retained earnings, because I want you to assume that every company we deal with in this class is a corporation. Okay, because we're doing this for corporations and not sole proprietorships or partnerships. Okay. All right. I am hopeful that this made sense to you and that it's helpful to you, and I'll have answered all your questions. Okay. If not, email me and let me know what your question is. Bye for now.